Hey everybody, happy Friday the 13th. Don't let that scare you. This is Rick Mount with Fairway Independent Mortgage out here in California, bringing you this week's market update. So Friday the 13th, reason to be scared, but actually a lot of the signs out there in the economy are positive, so shouldn't scare you. Many of the indicators that people look at on whether the economy is growing or shrinking or where we're at necessarily in the health of our economy are showing or pointing towards a healthy economy and some growth ahead. So business inventories recently released were higher than expected. Retail sales have been higher than expected. Unemployment number has dropped, although the unemployment claims actually rose this week. Go figure. I think it has to do with the creative math they use when calculating unemployment, but the overall unemployment rate has dropped. So many other indicators out there that are also suggesting signs that the economy is continuing to recover. So this is something that our friends at the Fed will pay very close attention to, as it'll affect their decisions towards their monetary policy. So let's talk about that for a second. So if you remember, the federal government, as part of the efforts to improve the economy, has been spending about $85 billion, yes, B with billion with a B, $85 billion a month on mortgage-backed securities and treasury bonds to help drive interest rates down and lower the cost of borrowing to help stimulate the economy. So with these increased signs of improving economy, the whispers in the hall are definitely starting to become louder about tapering or not to taper, and what the federal government will do as we come forward in those regards here soon. So many believe that the tapering could begin as quick as this month or before the end of the year. So rates will definitely have some upward pressures on them as the government begins to pull back their spending spree on keeping rates low. How high will rates go? Well, many people, many smarter than me, predict that rates will probably head towards the 5% range as the Fed begins to taper, and then will continue to take its direction from the economic news as we go forward for 2014. So most believe that we've come off our lows. It certainly put a lot of pressure on the mortgage-backed securities. Mortgage-backed securities have lost somewhere around 200 basis points since the middle of November, so driving the interest rates up into the mid-4s for a traditional 30-year conventional fixed rate for somebody with good credit. So I think there's an old saying in today's volatile times that pilots used to use that I think is applicable. So pilots used to say, hey, they'd rather be on the ground wishing they were in the air than in the air wishing they were on the ground. I think that is probably pretty applicable when it talks about locking in an interest rate in these days. I think you'd be better off locking than floating, as there's certainly more risk of the rates increasing or moving upwards than there are rewards of them coming back down. So keep that on the horizon as you look forward. Lastly, make sure to check out our Facebook page. We've got a campaign running this rest of this year. For every new like that we get, we're donating back to the Boot campaign to help serve those that have served us. So we appreciate your time. Make it a great week as we head into the holiday season, and we'll talk to you soon. Thanks.